Today we'll be introducing ourselves to accounting, and we'll just be looking at, understanding the accounting equation, as well as, looking at some accounting terminologies. So the accounting equation is simply assets is equals to liabilities plus capital. So it's assets, liability plus capital. When we say asset, what we mean by asset actually is what we mean by assets is assets are the resources that the entity that the business controls, the resources that the business controls as a result of past events. As a result of past events, your liability is the obligation that the entity has because of a number of activities that's engaged in the past. So we refer to liabilities as obligations of the entity that arise from past events. So while we said, assets are the resources that a business, an entity controls as a result of past events, liabilities is what arise, the obligations that arise as a result of some of these past events. Whereas our capital is the money that the owner you put into the business. Maybe a common definition would be the money you use to start a business. It might be what you use to start the business or what money you have, imputed in the business during the business and all of those. So they're the residual amount found by deducting all of the entity's liabilities from all of the entity's assets. And what do I mean by that? If we say that, asset is equals to liability plus capital, what we're saying is that, capital is what is remaining after you have taken up all of the obligations of the business. So capital is what the business is in a simple term owing to the owner of the business. So it's the owner's input, the owner's own money in the business. The liabilities are the obligations to external people apart from the owners of the business. You can put it in that way. So assets is equals to liabilities plus capital. And capital, we also refer to that as equity. So capital, we refer to that as equity. When you see capital or equity, it's the same thing. So let's test this that we have just said. So we said assets is equals to liabilities plus equity. So in this case, we have assets being 100,000 and liabilities being 60,000. What is the equity? What is the capital? What is the owner's input or money in this business? That would be assets minus liability. And that should give us 40,000 because we had already said that liabilities and equity is equals to assets. So if we add up 60 and 40, that should give us 100K. Do you want to try, working out the other ones? So in this case, we're looking for liabilities. What would that be? If assets is equals to liabilities plus equity, then here liability should be what? Assets minus equity. Assets minus equity. So do you want to try doing that? So that should be 30,000. And of course, here asset will be liabilities plus equity, which will give us 170,000. Okay, so let's try to do this, everyone. Based on what we have just looked at here, asset equals to liabilities plus equity. Do you want to quickly give this a try? So you can pause the video now and then try this. If you have done that, you realize that, as capital here, asset is equals to the accounting equation is asset is equals to liabilities plus capital. So capital here, therefore, would be what? Your asset minus liability. So 12,005 minus 1,008, and that should give you 10,700. If you do the same for question 2, that should give you 23,100. In question 3 and 4, we want you to look for liabilities. In this case, it should be assets minus capital. Assets minus capital should give you liabilities. So if you do 6,800 minus 12,500, you should have 4,300. Do the same for question 4, you would have 3,150. Question 5 and 6, we're looking for assets. I will say assets is equals to liabilities plus capital. So 6,300 plus 19,200 should give you 25,500. If you do same for question 6, you'd have 51,400. Question 7, we're looking for capital. We know that assets is equals to liabilities plus capital. So for us to get capital will be equals to what? Assets minus liabilities. So 55,000 minus 16,900 should give you 38,100. How you would know that you're right or wrong is, add up your liabilities and capital together, and they should be the same figure with your assets. Question 8, you would have 51,600. And how did we get that? You add 17,200 and 34,400. And for question 9, we're looking for liabilities. That will be assets minus capital, and that should give you 7,600. And finally, capital here would be asset minus liabilities, and that should give you 104,000. 104,100. And I hope this is clear. So for you to solve the accounting equation, assets is equals to liabilities plus capital. And we had said earlier on what asset is. Asset is the resources that you use in the entity, the resources of the entity, the resources of the business, as a result of past events. So we said your abilities are the obligations of the entity, the obligations, that have arisen because of, past events. And your capital is the owner's fund within the business. The owner's funds, it's when you deduct if we deduct the liabilities of the business from all of the assets of the business, that is your capital. That is the owner's funds or money within the business. Okay. So what's the example of assets that we know? What are those resources that are controlled by the entity? So we have cash, bank, building, investments, your account receivables. As we go on, you'll see how some of these things, fit into assets. They are resources of the business. Your inventory, that's your stock, your stock, the stock you have in the business, the equipment that you have, if you have lands and buildings, if you have furnitures and fittings, and all of those things then would be assets in the business. And as we go forward, we'll see that we would have current assets, would have non-current assets. So those assets that can easily be converted to cash, and those assets that are, kind of more fixed and they are not, going to be consumed easily within a year period. We'll see that as we go forward. Then what are the what is liability? We already said liabilities are obligations. So they are debts. They are debts. They're what the business is owing to outsiders, to creditors. We'll call those outsiders, creditors, whether they be suppliers, their banks, and all of those things. So those money that's the business owes to all of these people is the liability. So, they could be in form of, loans, account payable. So, you've gotten something from your creditors, you haven't paid, your notes payable, and, a creditor has a right to actually legally force us to liquidate if we are unable to pay their debts. So actually, creditors are very strong stakeholders, within the business. And if there's a case of liquidation, so if you've gone bankrupt, there's liquidation, and the law requires that creditors actually have to be paid first, before owner's claim. So be sure the shareholders claim or before the owner of the business claim on the business. Capital, on the other hand, we had said capital, is what the owner's input is in the business. So the owner's contribution in the business. It represents what the business owes to the owner. So it appears as though the business owes two people, the owners and the creditors. So capital is what, is the owner's input or contribution into the business. How capital can be increased is, you make profit. So you can just consider yourself as a sole proprietor. For example, you make profit and you have invested 5,000, and your 5,000 at the year end has become 5,500 because you have made a profit of 500. Instead of taking out the 500, out of the business, you have then retained your 500 into the business. We call that retained earnings. So you add back your profits or something, or your reserves. You put that back into the business. That increases the owner's contribution in the business. How capital can be reduced is if you begin to have drawings from the business. You're withdrawing cash out of the business. You're taking goods out of the business without replacing it with money. Those drawings or withdrawals can reduce, owner's contribution in the business. Or maybe if you make a loss. So if you've invested 5,000 into the business, and at the end of the year you lost 500. Now you have, instead of having a profit, you lost 500. You now have 4,500. That has reduced how much you have invested into the business. So a loss, joins or withdrawals can reduce actually capital. That's owner's contribution within the business. Okay, so let's look at profit. So we now understand what the accounting equation is. The accounting equation is your asset is equals to liabilities plus capital. And we've solved some of the examples. So let's look at profits. We said that your capital can actually increase in the business if there's if there's profit. So you add up, your profit into the business, you retain the earnings in the business. So how do you increase your profits? If you want to increase your profit, which would eventually, and if you retain that profit in the business, which eventually increases your capital, what you need to do is increase your revenue. What is your revenue? It is the payment you receive in the business as a result of, goods or services that you have provided to customers. So if you sell goods, customers will pay you money. That payment is your revenue. If you offer services, the clients or customers will pay you money, and that will be your revenue for the business. So once your revenue is always higher than your expenses, what are the expenses? They are the cost of you offering those services or selling those goods, to your customer. So once your revenue is higher, always higher than your expenses, you would have a profit. So to make a profit, to increase your profits, you want to ensure that you increase your revenue, but you cut down on your costs. You cut down on your expenses, and that would help you make profits, as a business. So we have said what, revenue. Revenue are the things, they are the proceeds you get from selling goods. They are the proceeds you get from delivering services that are related to your business activity. So it's important we clarify that for, and as we go on, in the module, we'll look at the difference between your capital, the different types of revenues and the different type of expenditures that we have. But, for now, once the proceeds is from, the sales of goods or services or the sales of things that are related to the business activity of the business, then that would consider as the revenue. The reason we're saying this is because, your revenue may arise from other sources that is not related to your business activity. So and we'll see that as as we go on. So say for example, so what are the types of revenue that we have? We would have sales revenue. So it's, proceeds from the sales of goods and services. You have your service revenue, you offer some service, you have rent revenue. So maybe you have a building, for example, and you rent it as is part of the building. That would be your rent revenue. We have your interest revenue, we have commission, and all of those things. The reason I have said here that revenue increases equity is that, just like we had said previously, that for you to increase your profit, revenue has to be increased. So once your revenue increases and that reflects in profit increase, and that profit is retained into the business, the equity, the capital of the owner, increases in the business. Expenses. Expenses are, like we've said, the cost of you offering the services and goods that you are selling. So that cost of assets consumed or services used in the business to earn revenue is your expenses. The expense is named according to the assets that consumed it or the service that used it. So for example, rent expense. So if you took out you rented out a building, that's a rent expense. So you're going to pay rent. If you're going to pay your workers' salary, that's a salary expense. If you're going to pay tax expense. So the expense is named according to the assets or the service that consumed it. And what expense it does is that it decreases equity, and that's why we said that you want to ensure that while revenue is increasing, that your expenses actually is reducing, so that you can have increased profits, which translates into increase in capital equity. Okay, so now let's do some more examples to test that we understand. So far, we've looked at the accounting equation. We've also looked at some terminologies. When we now understand what asset is, we know some examples of asset. We know what liabilities are. We know what capital is. We know the examples of liabilities and capital. We know what profit is. We know what how profit can be increased and how it can be reduced. We know what we can do to increase our capital in itself. So let's solve some of this questions, testing our accounting equation. The first one says 30,000 is assets, liability is 18,000, your capital, we don't know. So what is the accounting equation telling us? Accounting equation says assets is equals to liabilities from capital. So if you do liabilities, assets minus liabilities, you should be able to get capital. So I'll give you time to please finish up all of that, do that, and so you can pause the video and just do that. So hopefully now you've completed that, and that was very easy to to do, just like what we did initially. We'll just do an overview of this bit of it, the financial statements, and then we'll conclude with that. So we have, in this mode, we'll be looking at the three financial statements, the income statements, which, usually was called the statement of profit and loss. We have the statement of financial position, which used to be called the balance sheet, and we'll look at the cash flow statements. So with the income statement, what the income statement does is it looks like it measures the financial performance of the business over a specific accounting period. If you remember last time we discussed, the different accounting that we have, whether it's financial management accounting, and we said that we have specific publication period for our financial accounting. So you produce this within specific accounting period. The statement of financial position it measures the financial position of the business on a particular date. In fact, it's a snapshot. So at this date, December 31st, 2022, what is this business position? And that's what the statement of financial position tells us. The statement of your cash flow statement measures the movement of cash. So how much cash has moved, in this business from January to December, from January to April, from April to August, within a specific accounting period. Some terminologies we need to know before we begin to go into, in-depth discussion around each of these financial statements is with income statement, for example, you'll be seeing things like revenue, sales, which we have discussed already before now, in the previous slides, that they are the cash that the business generates through, generates from selling. So the proceeds you generate from selling goods, services. Your cost of sale is the cost of producing those goods or services that you have sold. So your cost of sale is your expense, what it has cost you to sell this good or services, what it has cost you to get this revenue. To calculate that, we would usually have our opening stock, what you've started with, plus what you have purchased, and then you deduct your closing inventory, and that tells you how much it has cost you to generate your revenue. Your inventory is the stock that the company holds for reselling purposes. As we go on, we'll see that, in fact, we could just say that now we have, different types of inventory. We could have your opening inventory, your closing inventory. We have your work in progress and all of those things. So which opening inventory is the value at the start of the period of stock at the start of the period. Your purchases is the stock that you have brought in, from supplier over the years, and then the closing one is the value that you have, that's left at the end of the year that is unsold. And you see all of these terminologies as we begin to prepare the income statements. The gross profit, on the other hand, is the difference between the money you have received from selling goods and services, or revenue, and the cost of making those revenues, so your cost of sale. So the difference between your revenue, your proceeds from sales, and the cost of sale is your gross profit. Your expense, on the other hand, which we have discussed, is the cost of incurring, cost incurred, by a business whilst you're providing the products or services to your customers that helps you to then generate sales revenue. Your dividends is part of the profits that you have distributed to shareholders. So it's the reward for investors. So if you're an investor, you'll be paid a dividends. So if you're the owner of the business, well, if we have a business and we have a number of shareholders in the business, the profits, the part of the profit that we distribute to different owners of the business, different part owners of the business who are called shareholders, is then the dividends. With statement of financial position, some terminologies key terms we need to know is the non-current asset, current asset. So, we had said earlier on that we have assets which are the resources controlled by the business because of, past events. So the non-current one are those resources that you have purchased within the business to use for more than a year. So it would not be exhausted within a year. When you use these resources, it will help you generate cash. The current assets, on the other hand, are those resources that you expect to be converted to cash. You expect to use them up within a year. Those will be your current assets. Account receivables are the credit customers owes to the business. So they are our debtors. These credit customers, what they owe is what we call the account receivables. What we owe our own creditors. So what we call those account payables. So they are suppliers who sell stock to us on credits, they are account payable. So those are what we're owing our suppliers. Non-current liabilities. So we've said liabilities are obligations, of the entity that have arisen as a result of past events. So non-current are those debts that won't last more than a year. Well, they would last more than a year. Non-current will last more than a year. We expect them that we will not have settled those obligations, within a year. But with current liability, we expect that we would have settled those obligations within the year. So within a year, we would have settled those obligations. And with that, we'd end today's discussion around looking at introducing ourselves to some basics of accounting, looking at the accounting equation, as well as some terminologies that we need to get used to before we go on. I'll see you in the next video.